What's going on, everybody? Welcome to a Capital Hungry weekly prep webinar. Currently roughly 7:40 p.m. Eastern, Sunday, August 11th. We're just going to be running through a recap of key events and price moves from last week, a scope of the fresh weekly pre-planned economic events, sentiment analysis and a bit of a fundamental refresher, market analysis across pairs, and then translating all this information into some intraday trade ideas. So last week was quite interesting. We didn't have that much important pre-planned economic data, but we were following up with a week where we saw an aggressive uptick in US unemployment and the unwinding of the Japanese yen carry trade with an excessive upside move in the Japanese yen currency and some downside in the Japanese stock market. The combination of global recession scares, mainly focused on the US labor market aggressively cooling, plus the unwinding of the Japanese yen carry trade, led to some fear, uncertainty, and doubt in markets and asset classes across the board that have been trending quite bullish over the course of the last 2 years. Whether these asset classes were at significant historical highs or even new all-time highs, we saw some profit-taking moves to start off the week. During the Monday, the Sunday weekly open from last week and into the Monday, we could see gold here having a downside move from the 24.55s all the way into the rough low of the 23.65s, nearing that very important liquidity zone we've been playing from NFP prices around the 23.50s. We also saw this take place on GJ specifically, printing some new lows all the way into the 181 prices, a major liquidity zone getting retested that we identified we could target into. US 30 saw the same profit-taking move and sell-off with a quite large surge when looking at the volatility index move to the upside, indicating more fear, uncertainty, and doubt into the markets, as well as more short selling, specifically in the US stock markets. Even the risk asset Bitcoin saw that downside to some new intraday lows around key level 50K flat. Now, we anticipated when looking at some of these bearish moves on the major risk assets in larger asset classes such as gold, that it could be relatively short-lived. More of a buyer profit-taking move on these asset classes from very high prices or even new all-time high prices, and that if we didn't get any new catalysts feeding into the fear, uncertainty, and doubt, we could easily see buyers grabbing the dip on the intraday price points across these asset classes and some type of relief of those downside moves. After the Monday sell-off, that's pretty much all we had take place. The remainder of the week from Tuesday to Friday just saw these asset classes recover a good chunk of the sell-off and start to see buyers grab the dip. Now, some asset classes are going to perform differently than others, of course. We are a lot more bullish on gold than we are on like US 30 from these prices. For example, US 30 on the higher time frame could see some further downside even into the actual first rate cuts by the Federal Reserve for some buy the rumor, sell the news plays, coming down to the 37K prices, and that would not be shocking at all. Gold has a lot more reasoning to be potentially bullish than the stock market from a fundamental perspective, where we've had some decrease in global economic data, which creates more uncertainty and doubt of market participants in those economies and markets, and leads to more appeal to gold's safe haven side and demand and inflows in gold there, or whether we have further escalations of geopolitical tensions, which also makes it more appealing to be pooling liquidity in gold, again, for its safe haven side, right? Where on US 30, whenever we see rate cuts actually take place, historically, stock markets actually turn bearish for a short period of time. Yes, rate cuts being priced in and having a buy the rumor, sell the news play can also be short-term bearish for gold, but I think the stock market is going to have a larger of a correction in terms of percent change than gold will. Gold still has some more supporting factors to keep it at elevated higher time frame prices. Where US 30, even if it came down to 37K, still very bullish on the higher time frames, but would be another bearish leg correction down to those prices. Now, regardless, most of these asset classes, such as the US stock market index, even looking at obviously Japan stock market index and global stocks, started to get that recovery for the rest of the week. This isn't full optimism back in control. This isn't full market greed, right? This is just a bit of a relief move of the fear, uncertainty, and doubt impact we saw from the start of the week. This doesn't mean that we're guaranteed for US 30 to go back to all-time highs or to see Bitcoin, for example, which is more of a market liquidity valve, to go back to all-time highs. It's just that we're not seeing any panic crash. We're not seeing any major market crash as the headlines were trying to make it at the start of the last week, right? So with gold, we anticipated that even if we retested into the 2350s again, or generally just started trading above the 2400s, we would still be looking for buys on gold. We anticipated with the market waves that take place, and especially with Bank of Japan playing the balancing act game, trying to minimize the downside impact on the Japanese stock market from market participants starting to price in tighter financial conditions that will be set by the Bank of Japan and the unwinding of the Japanese yen carry trade. We anticipated we could get some type of correction from the 180s and 181s here. That is pretty much what took place from Tuesday to Friday market close. As outside of that Monday sell-off, we didn't really have any other reactive events come into play when looking at the news headlines. And we also didn't really have any important economic data reports last week. Some of the more important ones are going to be this week, which we'll talk about when we go through the schedule. So we just saw gold bottom out at a key demand zone, still just sitting near its all-time highs when you're zooming out, and some decent buy plays. Have to be very adaptive of the price setups into this week, especially as we have US CPI in focus this week. And we know how much market participants eye the inflation reports to get some more policy positioning signals of what the central bank may do next and start to price that in ahead of time. It's what's been going on for a couple of years now, right? US 30, same idea. The panic selling seemed very intense when looking at mainstream media headlines and them just highlighting the red days, but it's still just profit-taking moves from new all-time highs. We're still held above this intraday demand zone. There's no major new fear, uncertainty, or doubt events, in my opinion, to lead to further bearish legs down here. What we're going to be eyeing this week is more of the economic data in focus. Bitcoin saw that profit-taking move, more short sellers taking advantage of the change in risk sentiment from the start of the week, but a lot of that got corrected by the end of the week as well, going from the bottom of 50K pretty much back to 60K. This doesn't mean I see Bitcoin or the stock market again going back to all-time highs. A lot of these risk assets, such as US 30 or Bitcoin, can come back to revisit lower demand zones or still be respecting some short-term bearish structure. But it's not like we're seeing some major COVID-style crash or 2008 GFC type of scenario. It's not like that at all, in my opinion, yet. US economic data, even though it's starting to cool, a lot of that is expected by economists and market participants. That is the inevitable lagged effects of having a tighter policy and raising rates and no longer, quote unquote, pumping the markets. That's what's going to happen. Economic activity is going to decline. And like we talked about in the webinars last week, whenever these various corporations across industries start to see their profits go down, don't have as much money via loans to keep reinvesting into expansion or reinvesting into the market for more profits and growth, the first thing they do is trim the fat, aka cut jobs, right? So yes, the unemployment rate, we predicted it very well, increasing, but it's not at any recessionary scare or major alarming levels just yet. I think a lot of the moves we saw in risk assets are just a change in flows, buyers liquidating positions. And even if US 30 wants to come back down to 37K minimum or even near these previous high points at 35,500, this is the US 34-hour chart. This is all-time high prices. You have to understand psychologically, the mainstream media, to push views, to grow engagement, to market more, advertise more, have more screen time, and far more of your attention. Any social media, any mainstream media, they're always gonna hyper focus on anything that's dramatic, anything that can bring fear, uncertainty, doubt. It attracts a lot more eyes. It gets a lot more people interested in what's going on, right? I had I had uncles that barely speak English, right? Punjabi Indian uncles that barely speak English when the stock market was dropping for that couple of days, talking about, oh shit, economy finished, right? Texting me saying, yo, is everything okay? And I was like, man, when I'm getting messages like that, I know it's nothing serious is going on yet, right? So when you're still zooming out, we can't ignore that just from the pandemic, we did not just recover pandemic crash back to previous high prices. We've been soaring since then. Even the rate hike cycle correction, when the Federal Reserve aggressively raised rates and tightened financial conditions, and the markets were pricing that in, even that just went to retest pandemic highs, and we surged and got even more gains from there as interest rates have still been up and still have huge bullish market structure on the higher time frame, right? So the markets, the mainstream media, all these different news outlets, their goal isn't to give you educational information or value so you can make smart investing or day trading decisions. Their job as their company and media is to just accumulate views, get the most views, farm the most attention, and then play the most commercials, advertisements, and so forth. So in my opinion, I can see US 30 seeing some corrections, even if it comes down to 37K flat, 36,500, I wouldn't be that alarmed. And an example of a risk asset like Bitcoin, even if we came back down to this liquidity zone in the mid 40K prices, it's not printing any new all-time highs at this point, and seeing something like this, I would not be that alarmed. It's going to get a lot of attention in social media and so forth for the views, but it would be pretty controlled corrections or profit-taking moves and shift in liquidity flows for the institutions in relation to the monstrous rallies we've seen on these risk assets, such as Bitcoin, stock market, even gold, right? Sorry, accidentally hit the mute button. So just wanted to give that little bit of a quick little psychology review and refresher. I do see US stock market, if it doesn't break back above previous highs here, doesn't fully fade out the downside move, maybe a 50% correction, like our analysis from the previous week, digging into 40K, wants to see some deeper bearish corrective waves, markets doing the buy the rumor, sell the news into the first predicted rate cut of the September FOMC. That's pretty normal movement to me. Maybe it's shocking to the mainstream media and the general public who has no clue what's been going on in the financial markets and economies, but that's going to be pretty normal expectations here. Okay. So I don't think the sell-off was anything crash inducing. Now on GJ, the GJ, when we're looking at obviously a Bank of England and the UK, which is starting to enter a rate cut cycle, and Bank of Japan, even though they need to play the balancing act game to prevent a crash on the Japanese stock market, that is a real risk, is the Japanese stock market. If they're way too aggressive with signaling tighter financial conditions, and the unwinding of the yen carry trade is gets blown out of proportion there. That can lead to a lot more downside in the Japanese stock market and really fuck up their economy worse than it already is. So with GJ, yes, the tides are shifting. We are potentially starting to see a shift in rate differential. The main reason we've been riding buys on GJ, especially from 2022 onward, was because the Bank of England did their most aggressive rate hike cycle in years. The same time, Bank of Japan was still keeping interest rates in the negative. Now we're going to start to see that shift a little bit. But that doesn't mean you're not going to have huge corrective waves. Even when there is a huge macro rate differential of Bank of England raising rates above 5% and Bank of Japan still keeping it negative, even though it's very easy to look in hindsight, but we did call it in Capital Hungary all the buys up to these prices, minimum to Brexit crisis prices, right? It's not like you don't see market stability and price stability via exchanging of order flow or simply buyers liquidating positions on certain asset classes and exiting the market. Even amidst this bullish structure, you had these huge bearish waves and bearish corrections. I do see GJ becoming a lot more bearish on the higher time frame, as explained last week, especially due to that rate differential starting to shift a bit and some more demand that can be bought up in the Japanese yen from such historical low favorable prices. The same time, obviously, they're going to be doing some more rate hikes or slowing down their unlimited bond buying program over the course of the years through 2020 into 2026. But I could still see before another sell-off, if we're not printing new lows in these waves, GJ could easily come up to 192s, even 195s before we really see another higher time frame bearish leg down, maybe from some more Bank of England dovish signals and rate cut signals, or Bank of Japan, once the Japanese stock market stabilizes a little bit, doing another inevitable rate hike, and the market's starting to price that in via their signals and clues. So that's still something we're going to be looking at on GJ. Dollar has been interesting, but we've been adapting to dollar bears due to declining US economic data, which leads to less confidence for market participants in the US economy and dollar more bearish. And of course, markets pricing in Federal Reserve rate cut bets, which leaves dollar individually a bit more bearish. Alongside the technical structure we've been playing here with some new intraday lower lows being printed and just some minor pullback phases, right? This is the main reason we've been looking for some of those aggressive pullbacks on UCAD from the new highs that were printed and snapping back below previous highs here. That's why I've been starting to look for the Euro USD buy moves and the GBP USD buy moves. And that still looks active, in my opinion, at least until we unwind some of the more important data through this week, which is US inflation figures, and we'll talk about that. The only way this week specifically, besides having any escalations of geopolitical tensions, which can obviously increase dollar's demand due to its safe haven appeal on the global stage, the only way this week I see dollar picking up strength without reactive events is if we have higher than expected US inflation figures, right? Or, of course, if we have other US economic data reporting this week still optimistic, bringing back a little bit of faith and confidence in the US economy after that shocking unemployment report, and, of course, the pushback on rate cut expectations if inflation isn't smoothly trending down towards the Fed's goals and is seeing some upside fluctuations, especially if that upside fluctuation is surprising being much higher than forecast and higher than maximum expectations, which these data reports move in waves, just like price moves in waves and everything moves in waves. Nothing just stays optimistic forever. Nothing stays pessimistic forever, right? We've seen how different data trends, whether it's labor market data, inflation data, we've studied it, back tested it, reviewed it. So there is potential dollar could see some bounces this week, only mainly if we get the kicker that inflation is seeing an uptick. But if inflation's still cooling, other US economic data still generally weak or neutral due to policy lag effects, then we're still going to be playing some dollar bears for the time being, especially if dollar's still trading below 103.64 previous lows, or just breaking back below gray zone 103.15, and still maintaining this bearish market structure formation. Right? If that's the case, dollar could easily revisit those lows back into this liquidity zone and even start to see, if we have very optimistic inflation, trending back down to the lower 101s before thinking about buys again. But me personally, what I see with dollar movement is something like this, that we could still see downside revisitations of 102.5 before thinking about any bullish bounces. This means that GBP/USD, if it doesn't really break any lower, could easily come back up to like gray zone here, even 1.289s. Euro/USD could easily revisit this previous intraday high around 1.0985. UCAD may come back down to same demand zone lows at the 1.363s before even thinking about buys again. Something we still have to note with dollar movement. Dollar still looks generally softer. But nothing really much to recap in terms of what happened on dollar pairs. The entire week, Euro/USD ranged, still respected our buy analysis above the gray zone. GU ranged the entire week, but then saw some bounces towards the end of the week following our analysis. UCAD had some pretty clean bearish pullback moves and sells that we called out. But that was just a little bit of a weekly recap and refresher, plus some other tidbits thrown in there, some other nuggets thrown in there, and review points. Before we jump into the sentiment analysis, individual market analysis, and trade ideas, let's do a quick scan of the economic calendar, because unlike last week, we do have some important data this week. Last week was pretty quiet in terms of pre-planned economic events, but it was exciting with the sell-off at the start of the week and us buying the dip for the rest of the week. But we're going to see what we're setting up this week now. Through the weekly flow, you guys will get a copy of this sent to you. I'm just going to be quickly highlighting some of the important in-focus events for the main asset classes and pairs that we be trading, okay? So August 11th, nothing really crazy going on for this Sunday market open through Asian hours. August 12th, nothing really crazy going on through the London and European trading session or the North American trading session. North American trading session post-London close, if you are a commodities trader, you do have to look out for some of these stock reportings for these individual commodities here. The next set of really important data that we're going to be looking at is for GBP pairs August 13th, pre-London hours. This is your UK equivalent of your US non-farm payroll day, right? You have your job change, unemployment rate, average earnings, and overall payroll change there, right? You can see unemployment rate is pretty similar, pretty close to Fed levels, slightly higher than US levels. It's slightly higher where it's already sitting at around 4.4%. They're expecting to see further signs of cooling in the labor market and an increase to 4.5. Now, the one thing you have to look out for is when the market is already expecting something through the forecast. If you just hit right on that forecast, you don't really get too much intraday volume or volatility. You don't really get too much action, right? So if we want to see some GBP bears on August 13th, I would want to see unemployment rate coming out at 4.6%, having a 0.2% bounce, a jump, similar to the US unemployment rate had. That would be a bit more of a shock factor, even add on to the global recession scares fears, and lead to a change in flows. Safe havens having some strength, but obviously risk assets, risk currencies, and specifically the British pound having some weakness. If we just come out right on forecast, Obviously, the sentiment still won't be that optimistic, but because it's expected, it's not going to hold that much market weight. Then, August 13th, the North American trading session, we got some producer price index data. PPI, where I mainly look at the yearly change, final demand yearly here, is still expected to decrease and have quite a large decrease when you're looking at yearly change from a prior 2.6 to 2.3, with maximum expectations being lower than prior. So it does look like there's high expectations US inflation overall will still be smoothly trending lower. If that is the case, obviously producer price index isn't as important as CPI, but because during this month of August, PPI is getting reported a day before CPI, markets can start to move ahead of the curve if PPI is significantly lower, right? Still being optimistic with the progress on inflation and supporting further rate cut bets short-term impact with Fed expectations there. Then for our New Zealand pair traders, keep in mind through that Asian session, you have the rate decision by your Reserve Bank of New Zealand. August 14th, pre-London hours, 2 a.m. Eastern, we got CPI figures for the UK. Now, UK CPI and other inflation figures such as retail producer inflation, producer price inflation, RPI, RPIX, and so forth. I'm mainly looking at CPI year over year, CPI month over month, maybe the PPI year over year as well. But these two are the real ones in focus, with this one being the main character of the night, okay? They're expecting us to see a slight increase with yearly inflation in the UK. Now, this can bring some short-term GBP strength, but it may be relatively short-lived. We've already seen UK inflation hit that universal central bank goal of 2%. Seeing fluctuations as you hit the target of 2% are very normal, right? Going from 2% back up to 2.3 is nothing that alarming. If we're lower than that, that's still going to be taken as dovish signals and cues of what the data is signaling the Bank of England will do, because the market was expecting us to see an uptick to 2.3%, and we're still coming out lower than that, which would still just be hovering around Bank of England and other major central banks' inflation goals. So unless CPI is coming out above 2.4, I don't see it bringing that much GBP strength. We're still probably going to see dovish rate cut bets holding the most weight for Bank of England signals, unless CPI year over year comes out above the maximum expectations, which you can see right here is 2.4%. August 14th, getting deeper into the London session hours at Asian session close, 5 a.m. Eastern, we got some important Euro economic data for our Euro USD traders and anybody that may be trading Euro JPY or other Euro pairs of your liking. We have some employment data, GDP data, and industrial manufacturing data. My main focus is the quarterly and yearly flash estimates for GDP. I want to see how much of a beating growth expectations in the Eurozone have been taking with financial conditions being tighter. And obviously, ECB has gone from negative rates up into positive territory, where the Euro economy is not nearly as resilient compared to the US economy, right? Having any decreases in this data, decreases in growth expectations, that can still keep ECB dovish sentiment active and bring some euro weakness. Something we need to look out for as we've been playing Euro USD buys, but during this day, August 14th, we may see a bearish pullback short term due to the outcome of this growth data. August 14th, going into the highly anticipated, important North American trading session for the US CPI release. I'm primarily looking at CPI headline year over year and monthly change. This being on the main stage. Forecast is the same as prior. Minimum and maximum expectations are very neutral. They're 0.1% higher than forecast or 0.1% lower than forecast. So it's really a 50-50 toss-up with what market participants are expecting for this inflation report. It also means because the minimum and maximum is so tightly squeezed, it's only a 0.1% range change from the forecast, that if we do see any uptick above 3.1%, that could be the catalyst like I was talking about on dollar, where you could see some dollar bulls. But if we're coming out right on forecast, or if we're still if we're coming out right on forecast, that's just going to be some lower time frame price whipsaws, not that much market impact, no overall large intraday volume or volatility being introduced to the market. If we want to see rate cut bets still holding some weight, we want to come out at 2.9, preferably even lower. That still keeps dollar bearish, stock market more bullish at those higher time frame high prices. Gold probably still sitting at those same higher time frame high prices as well. Now, on August 14th, Asian session, we have some in focus Japan growth data. GDP quarterly. I'm primarily looking at the annualized and the quarterly data here, where both are expected to see some quite sharp rebounds. If we do see healthy Japan economic data this day that's exceeding the forecast outside of expectations there to bring some more intraday volatility, this can bring some Japanese yen strength. This is something we need to be mindful about as GJ's in potentially corrective form now. After that major sell-off, GJ's in this corrective form. This data report bringing yen strength could be the reason we see from an intraday high a bearish pullback before still holding the corrective form to retest better sell zones. I don't think it's going to be anything crazy optimistic to bring some huge strength in the yen, but some short-term strength on that day, at least in my opinion. Then, the next set of important data for the major asset classes that we trade is going into August 15th, pre-London hours, 2 a.m. Eastern. We have a whole flurry of data here for the UK. This is where you have to be very careful just in general. Why is that? Because you're not just looking at data reporting from one part of the economy. You got growth figures, you got some inflation data with services information, you got manufacturing and industrial data, you got business investing information, trade balance information, and so forth. High probability you're going to get a lot more lower time frame noise, liquidity grabs, price whipsaws just with the initial release. We have to see the more important reports, the outcome of that, and how it lines up with price action and market structure. What do I see as the more important reports out of this entire collection of data here? I'm mainly looking at this, 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 and this. Mainly the growth figures, important industrial and manufacturing report, and the services yearly data. We're going to talk about this more specifically during that day, so we can give a further in-depth breakdown of data expectations because there's so many reports, alongside where prices are sitting on GBP pairs going into the August 15th data, as we still got like 4 days from there. Then August 15th, North American trading session. We also got some important US data, all being released at 8:30 a.m. Eastern. A Fed manufacturing business report, a jobs report with initial jobless claims, a Philly Fed business index report alongside the New York Fed one, retail sales, and then later on industrial production. In my opinion, this is a day where we have the potential, if retail sales is rebounding from the neutral 0%, and the Philly Fed business index isn't dropping as low as the forecast, with initial jobless claims just being back to neutral numbers now. If we get some neutral to optimistic data, this is a day towards the end of the business week where we may see a bit of a dollar bounce and gold bearish move short term. I don't think this data is going to be anything hyper optimistic to lead to a huge reversal on the dollar or huge aggressive bearish move, but something to look out for. August 16th, London trading session, UK retail sales expected to see some sharp rebounding as consumer prices have been going down. So you have more optimistic spending in the UK economy for the time being, as policy lag effects haven't had a huge impact just yet. Just been slowly having a trickle effect on weakening these economies with tighter financial conditions. Nothing recessionary scare or alarming yet. So this is a day where if we exceed these forecasted expectations, can see some GBP bulls. But unlike last week, we have a lot of economic data in focus this week, and we still need to keep our headlines on the newsroom for any reactive events. We did have some bubbling of geopolitical tensions over the weekend, but nothing to actually impact markets as we lacked any price gaps at market open. With our central bank and political events, just need to keep an eye out for Fed speakers pretty much from August 13th into the end of the week, scattered throughout the week. You guys will be getting a copy of this sent through the weekly flow. Where can I get this? You have, as a new member, you shouldn't even be joining these weekly prep webinars. You should still be going through the educational content so you can focus on learning more, understanding everything we're doing and why we're doing it. Otherwise, you're wasting your time by joining these webinars where you don't really have a clue what's going on. So, you know what I mean? Don't waste your own money. Don't waste your own time. Time's precious. And make sure you get the full value out of Capital Hungry by following the learning process. Gain the foundational knowledge first, build a solid foundation, start to grow from there. If you don't build a solid foundation, anything you try to build will just crumble. All right, now getting into our individual technical analysis alongside some fundamental refreshers for gold, GJ, Euro USD, other dollar pairs, and US 30. Bitcoin, I'll be doing an individual. Actually, we can just start throwing Bitcoin into the weekly rotation. But I'm going to do one more individual analysis on Bitcoin. And then we're just going to start throwing it into the weekly rotation with all these pairs we analyze already. Because at the end of the day, Bitcoin is just another risk asset traded against the dollar, still following overall macro central banking fundamentals, liquidity flows, and technicals. So we'll throw it into the rotation next time, but I'll do an individual analysis on it. So let's get into the nitty gritty, shall we? Sorry, I was just taking a sip of water. Okay, gold. So we can see that gold did have a profit-taking move from previous highs, which are also new all-time highs, roughly around the 2470s. But this is a sequence of events we've seen many times before, and this is something we understand is very common in universal market movement whenever you have an asset class surging to historical high prices or new all-time high prices, especially when those new all-time highs feel like they're printed every single month, like we've been seeing with the US stock markets or with gold, which have had fundamental reasons to support it, but the exchange of hands, buyers liquidating positions, potential positions being covered in other asset classes, liquidity moving from one asset class to another, that's what leads to these technical pullback waves that we observe as manual retail traders, right? That's all that this looked like to me. That's why we were still calling some great buys above the 2350s. Now, one thing we have to look out for is that we could still see aggressive bearish legs down into these zones before seeing further buys again. For example, just as a scenario for this week specifically, if US inflation is edging slightly higher, above 3.1% maximum expectations, that would easily be a catalyst for gold to come down into the 2360s, bounce, even break lower and come down to the 2300s before seeing better buys again, right? We do have the potential for large intraday pullback waves. But nonetheless, I'm still higher time frame bullish on gold, just being a little bit mindful of the key events that will be unwinding this week and the prices we're sitting at. When we're looking at the intraday time frames on gold, we still have very strong bullish structure that's been maintained since the end of 2022 through 2023 and the majority of 2024. Do I see us retesting this higher time frame zone into the 2000s here for no reason? No. On the intraday time frames and just zooming out here, gold is still very bullish above the 2280s, and we're still holding that intraday support level around the high 2350s, low 2360s. We may see catalysts sweep us into these areas, but I really think we're gonna need to see major bearish fundamental catalysts for gold, like complete ceasefires of geopolitical tensions, or very healthy, resilient US economic data, or a complete pushback of rate cut expectations, which with much higher than expected inflation figures for consecutive months with CPI, US PCE reporting, to see any bearish moves down to the 2080s. We may not see a correction like that into this area for another year or two, maybe. Right now, gold is still in no man's land in terms of being in price discovery mode, essentially. We really just saw these prices over the last few months, right? And then started to identify those algorithmic levels based on lower time frame reactions. But we're still holding bullish above 2360s, 2280s on the low end here, right? I'm not getting fully shaken out just because we had a bit of a profit-taking move from previous all-time highs, that a good chunk of it ended up getting faded out by the Friday close last week, right? If we're still seeing policy lag effects working its way through the US economy, weakening economic activity, labor market data cooling, consumer activity dropping because they have less money to spend, personal savings depleted, and already in heavy credit card debt and other consumer debt. If we still have inflation sitting at the same levels or further dropping, which is still the Fed's goal of achieving 2%, and they do have the tighter financial conditions to maintain and achieve that 2% goal, if we do have further escalations of geopolitical tensions, which, just understanding human nature, there's a higher probability of getting escalations of tensions rather than some peace talks or like real peace. You know what I mean? Even a lot of the quote unquote peace talks or ceasefires end up being relatively short lived. They just prolong they just prolong on the macro scale how extended these various wars can be, right? Like wars can last years and years long. If we still have those escalations, weaker data, lower inflation figures or normal inflation figures, gold's still going to be trending back to these highs, even higher highs, getting into the 2500s in my opinion. I'm not really fully confident, like we haven't been for the last year, to play gold bears. Any of the gold bears that we've played, we've adapted very well. We've never tried to call a top or some sell-off, but we adapt very well to the second half of the pullback phases, understanding, okay, we're starting to see a correction. We're starting to see a bit of a relief on the rally, the market moving in waves, right? But to me, gold's still very bullish above the 2350s, 2400s, even current prices. We may have a bit of a slower start to this week, just continuing from the Friday moves, as a lot of the more anticipated economic data is in the second half of the week, and we haven't seen any geopolitical tensions from the headlines over the weekend holding weight. But one thing I'm looking out for when we're zooming out is the potential for an exact same move like this, where you have a sell-off, a bit of an aggressive bounce, and another bearish leg down to lower demand zones. That's one thing I'm looking out for just from a pricing perspective. If we do not see into this fresh new week us trading back above the previous all-time highs and around the same rejection point here, then seeing a bearish leg down short term, especially if we show breaks of intraday support levels and the signs of exhaustion of not printing any new highs, which if we're not technically breaking above the previous all-time highs in this price sensitivity area, roughly around 2430 to 2440 on the intraday timeframes, it shows me that buyers don't want to continue to pull in from these prices. We may see more profit taking or more short orders overall in the market on that duration of time and retest lower demand zones before buyers are more confident in buying gold again. So this is something I'm looking out for price setups that could even be going into the CPI data and just technically understanding gold sitting at all-time high prices and adapting to the waves. If we start to trade, if we don't print any new highs on the intraday from Friday's last high point, which is pretty much lining up with these previous all-time highs to the left, and this bit of a rejection point here, if we're not breaking above there, seeing some bearish legs down to retest lower demand zones before we think about buys again is something that's very normal on gold. You can see, even when you're playing the higher time frame bullish bias, and you can get some fantastic bounces, it's very rare that gold just retests into an area one time and just starts to completely reverse. There's many times you can sink to the same demand zone, even slightly lower, right? This was a great bounce, but if we can identify technically no more buy orders entering the market from these all-time high prices and near the new all-time highs, seeing that type of bearish corrective wave into NFP liquidity grab prices on the minimum, around 2350s wouldn't be out of the ordinary. The reason why I'm explaining all of this is because it's very easy to look at gold right now and say it's bullish. It's very easy to look here and say it's still bullish. But when you're day trading gold, scalping gold, trying to set up swing positions, these pullback waves or short-term bearish legs down that can last multiple days or multiple sessions, it's very important to us. And if we can identify that at a key price point, what it helps us do is prevent some losses, adapt to the wave accordingly, whether you're short-term selling it for scalps or day trades, and better position yourself to play the higher time frame trend. Yes, the higher time frame trend eventually does take over again, but it could be days later, it could be due to a fundamental catalyst, or it could be due after retesting better demanded prices. Does that make sense to everyone on gold? This is something I'm being very mindful about around this yellow zone of price, where we've seen a bounce into here before, but still come lower, where we've seen profit-taking moves from previous all-time highs here, where we still technically started to top off by the Friday close last week, conveniently there, right? So then dissecting that price anatomy even deeper, alongside what price action is telling us, we got some very important areas of interest. Whenever you're dealing with higher volume and volatility and larger market moves, you want to narrow down your areas of interest. We, of course, got the 2350s. We have got that zone from roughly the 2380s. We got the newest all-time highs were printed and the previous all-time highs in that price zone around the 2440s. Yes, you could get bounces at any price, but you're going to have the highest probability of winning trades if you narrow down to intraday and higher time frame points of interest. Now, these are going to be our main areas of interest. We're also going to be seeing some medium-term zones within the area we're sitting in. You could say that that is right here, around these previous rejection points in this slight support level. And you could also say that's around here, around that DB leg as well. Basically, what I'm seeing is that if we're not showing the buy side volume into the first half of the week to be trading above the 24.35s to 24.40s, if we're also breaking below this minor medium term level and support level around the 24.30s, we could easily start to see those bearish legs down to the higher time frame zones before thinking about better bullish positioning, whether that's 23.80 jumping back into bullish moves, or even if that's back to 23.50. And if we don't have those, the only way I'd feel more confident buying is above 24.40. Now, out of 1,000 prices, out of hundreds of prices, you've narrowed down that amidst this large higher time frame bullish structure, there's really only 3 areas I'd be looking for great buys, right? This helps you remove a lot of the noise, right? Now, this also tells me pricing information to play with if I'm scalping or day trading or monitoring price as I'm waiting for these buy areas. If I don't trade above 24.40, if I break this local level support here, I can at least see a bearish scalp down day trade to 24.40. And if I break below there, I know I'm coming down to that higher time frame interest point, 23.80, before I even think about a bullish move. This is how you start to create your trade ideas alongside your trading plan and what you're comfortable with trading, whether it's day trading, swing trading, or whatever it may be. And this is how you avoid a lot of the lower time frame noise. You want to start looking at lower time frame, 1 minute time frame, as you're at these areas of interest. We only got 3 major buy zones out of hundreds of prices, and then 2 medium term zones. These pretty much line up with the key levels anyways, right? You have your key level 24.40, key level 24.20, key level 24.01, key level 23.80s, key level 23.50s. The key levels are not meant for you to execute every single key level. You still have to narrow down based on recent liquidity zones and where you've seen reactions on where you would execute trades. The key levels are guide points. You know, if you're still breaking below a key level as you're making your way down, that it's not time to buy yet. You know, if you're approaching a key level that also happens to be an identified liquidity zone for buys and you're not breaking lower, it is time to buy now. Alongside obviously having the knowledge from the fundamentals, which, yes, the fundamental bias on gold is still very bullish, but these price waves matter to us. Does that make sense to everybody? Everybody following along with that? Bit of an educational refresher, pricing refresher, falls in line with trading psychology as well. Cleaning up your trade ideas, removing some of the noise from your mind and from the charts, right? A lot of people will say, Jeev, your chart has so many levels. Like, what the hell does all this mean? Yes, these are key levels where you can see price reaction points. Just because I have all these key levels doesn't mean they're all execution points. Really now, when you bring it all down together with this overlay here of the trade ideas, there's about 2 sell trade ideas and 3 buy areas, right? I know that if I don't break above 24.30 and I start breaking below 24.20, that clearly there's not as much buyer volume pooling into the market from these historical high prices. We're seeing some more short sellers in control. We can see bearish legs down to 2400s and even the 2380s. I can then make an objective logical decision on either to take advantage of that sell or simply observe the bearish price action and not take buys. The latter is something a lot of people ignore. Trade ideas are not just where to execute trades. It's also where not to execute trades. It's also to prevent you from taking stupid trades. Does that make sense, everybody? Not a lot of people teach that. Trade ideas are not just about marking out where to take trades. On the flip side, when you mark out where to take trades and plan that, it also creates an area of where not to take trades. Too many people ignore that side, which is equally, if not more important, in my opinion. Knowing where not to take trades will save you a lot of losses, save you a lot of money, save you a lot of stress, save you a lot of energy, save you from losing your hair or aging too aggressively. You guys get what I'm saying? It's not just that if we break lower bearish here that we can drive down to 2377. It prevents me from taking buys this whole way down, which a lot of people, because gold is so bullish on the higher time frame, every 30 pips of dropping, every 100 pips of dropping, if they see a bullish candle, okay, it's time to buy again. Gold can go down and have a bearish wave down amidst higher time frame bullish structure, right? This is all very bullish. Overall, it's bullish. But as a day trader and scalper, gold can come down over 700 pips before it's time to buy again. But people, every single little rejection candle they see, they're starting to buy. Where did you actually start to get the buys coming into play? From a higher time frame liquidity zone, not just from random lower time frame rejections or a single hourly rejection wick in a bullish candle. More times than not, the better, cleaner, higher probability buy moves are taking off from important fundamental prices or higher time frame liquidity zones. This is very important for gold traders. Gold is a vicious beast. A lot of people have been burned by gold or hate trading it because they do not know how to adapt to these waves. We understand that if we're not printing above 2440, it's not time to continue the bullish trend yet. We may see this bearish wave coming all the way back down here again before continuing higher to retest better buy zones. To me, the real buy zones are 2350, 2380, and 2440, where I would even think about high probability buys. Anything in between that, it would be an area where I'd want to avoid a buy. More than likely, the buy may be very short-lived compared to what I'm looking to get. For me as a day trader, especially with gold's increased volatility, I'm looking to get 100, 200, 300 pips. Swing trader may be looking to get 1,000 pips. It might not seem like it. This is a 1,000 pip rally. This is a 1,000 pip rally. More than it, right? 1,300 pips. Day traders, if you get from a 2380 bounce here, even back to 2400, that's 200 pips. Very, very realistic for day traders now with the volatility on gold. You guys remember when I was talking about the volatility comparison of the volatility increase on GJ? It's the same thing now. Gold is the same idea. It's always been like that, but you have to adjust accordingly. I told you exactly where my main areas of interest are. If 2452 for you is something very significant for whatever reason you have, then so be it. For me, I've just marked it out for you. I've just showed you my entire view and opinion. You get what I'm saying? Right? So that is something we need to look out for and stay very adaptive with gold price movement. So with that being said, if gold does not break above 2435s and starts to trade below 2420s, I see some type of corrective wave taking place. Minimum to go to the 2400s, maybe even the 2383s before seeing buy reactions again. Right? For intraday trade ideas. Otherwise, if I want to see any further bullish moves on gold from current pricing to have confidence in further simple continuation gold buys in the main higher time frame trend without any type of pullback or liquidity sweeps to retest lower demand zones, If we break above 2440s, break and retest, this is just simple continuation moves, starting to dig higher near the all-time highs again. Does that make sense to everybody? Everybody following along? On the bearish side here, you'd pretty much be wanting to see something like this, failing to break higher, the bullish candles getting weaker, bearish break below 2420s, maybe a short-term bounce off 2400, retesting lower demand zone before continuing higher. That's how like the price action sequence of events would develop over the course of hours and multiple sessions and days. GJ. So I still see that we're going to be extending this pullback on GJ, which in my opinion, on the minimum, can still be digging into the 192s before we start to look for better sell positioning. I'm still not fully confident in Japanese yen bulls until much later in the week, depending on Japan economic data figures. And I still see that the Bank of Japan won't let the Japanese stock market die. If they start to see more demand in the Japanese yen and outflow out of the Japanese stock market and aggressive changes in flows there due to the market starting to price in the tighter financial conditions by the Bank of Japan, I still think they will intersect and pump the markets manually if they need to, or at least with what we saw last week, have some Bank of Japan speakers bring some very dovish comments to slow down the markets. They would prefer to use their mouth and tongue, not in like a sexual way there to slow down the markets, but they prefer to use their speech to slow down the markets rather than actually using their resources and digging into their currency reserves and liquidity there. So I don't think they're just going to let the Japanese stock market die that way. Is it inevitable that the Japanese stock market will be more bearish during their rate hike cycle? Yes. But I could see in the example of the Japan stock market index, even coming back near correcting the downside move prices into around the 37K price handle before seeing more bearish plays in the Japanese stock market. And then with more demand in the Japanese stock market short term, yen individually starting to turn more softer here and either consolidating or correcting this upside move, I can still see GJ moving in this wave formation to retest into like the 192s before we see potential better sell positioning. Which obviously we have the UK inflation, which can bring a little bit of GBP strength if it is higher than the forecast, bouncing from the 2% targets, short-term strength, and the Japan economic data in the second half of the week. So I still see GJ having a reaction and some more relief of the downside move from this important higher time frame liquidity zone, potentially digging into the 192s before we see better sell positioning again, especially if we're still holding above the 185s and that corrective bullish market structure formation. Oh shit, accidentally hit mute. My bad. If we, what was muted the last couple of seconds? I think I accidentally hit something on my keyboard. Last 30 seconds. You guys hear when I was talking about GJ still respecting that demand zone short term? Do you guys hear when I was talking about the Japan stock market? Short term relief. Okay, okay. So it's just the last few seconds here. All right. So I can still see GJ. Also, if we break below this key level here, just for price setups into the new week, and how we've had some pretty aggressive bearish waves in corrective structure, which we understand is the price anatomy of corrective structure, I could see a short-term move. I could see a short-term move to this 185 pricing, 184.5, before seeing some more bullish plays. Music? I don't have any music playing. My room's completely silent. Is the mic okay? What's going on today, guys? There's nothing playing on my desktop. I'm not sharing computer sound, and I have zero music playing. Like there's nothing. I'm in a dark, quiet, cold room. Might as well be in a prison cell. Okay, okay. Okay, so if we see the break below key level here for new weekly price setups, this bearish leg might not seem like much, but it's 200 pips to retest this liquidity zone and key level before better buys. Or if we flip above current prices around 187.5 to 187.8, as well as break above this last intraday pie price, which is around 188.2, I can still see GJ overall playing that corrective structure and playing that pullback wave, like this type of price formation, to retest into the 192.8 key level and retest the bearish structure before potentially setting up better sell positioning. So GJ, we're still just extending trade ideas from last week's market analysis. The buys we've been calling from the 181s in this corrective formation to retest better sell zones of interest after having more relief of the bearish downside moves as the Japanese stock market recovers and the Bank of Japan needs to play that balancing act game. Now with our dollar pairs. Dollar's at an interesting price where, to me, there's still a lot of near-term fundamentals that can keep dollar bearish. The increase of recession scares from weaker economic data due to policy lag effects, as well as having the decrease in inflation figures, which keeps rate cut bets active on the currency side and less demand in the dollar short term. This is still printing technical bearish structure here, with intraday lower lows being printed and more of the impulsive moves being bearish legs down, and the bullish moves being a lot more corrective, slow, and choppy, like from this low to here, and potentially from this low to here. If we see dollar technically breaking above this double top point, we could see one more sweep of short-term dollar bulls even into data setups before seeing another bearish leg down. Otherwise, if we're still holding below here, I'm still bearish on the dollar to at least retest into 102.5s. It's either we get one more little pullback to retest a bearish structure, previous lows, 103.8, 68, sorry, or of course the breaks and holds below 103. Dollar still looks bearish to me in my opinion. Now, because dollar is in a secondary phase of market structure against the impulsive bearish legs, you're seeing a lot more wave formation in a corrective phase, which is the price anatomy of any secondary phase of market structure, whether you're having a pullback or a consolidation. The consolidations are just sideways ranges, price whipsawing up and down. The pullbacks are more diagonal consolidations, pulling back price in a slow and steady fashion to retest better areas of interest before the institutional algos start to fire off and insert some more orders from those better prices, right? So with dollar, we may see one more sweep into like 103.65 or hold below the gray zone. On dollar pairs, I still want to play some of the dollar weakness and bullish structure in the example of Euro USD and some buys on GU and some short-term bears on UCAD. I'm looking at 1.09, 1.087, and 1.093 buys on Euro USD for the trade ideas. Overall, let's do a quick review of some of our dollar pairs individually on the higher time frame because we haven't done that in a minute. Right now, Euro USD higher time frames very bearish. Yes, dollar buyers are eventually going to come back into the scene. The US economy on the macro is more resilient than its global counterparts. You're still going to have the ECB with lower interest rates than the Fed. Euro bears will come back into the scene, just not yet. I still see that on the minimum, Euro USD can retest into this same sell side liquidity zone into the rough 1.12s alongside dollar being short-term bearish into the lower 102s and 101s before we see higher time frame positioning. This can potentially take place over the next months, digging into this area before better sells. This is quite large pip change and price change on Euro USD, right? So that's something we have to understand. Yes, Euro USD higher time frame, GBP USD higher time frame is bearish. Yes, USD CAD higher time frames bullish. Dollar higher time frame is bullish. Yes, dollar has a lot of potential to see more buyers coming into the scene from lower prices and still has a lot of fundamental support that can bring some more bulls in the near future, like other central banks having rates lower than the Federal Reserve and other economies also significantly weakening and the US economy being a lot more resilient than them down the line, right? But timing's very important. If Euro USD has the potential to go up to a deeper sell zone, which can last weeks and months, we're not going to be selling this whole way up. We're going to be adapting to the buys as day traders and scalpers until we get better bearish positioning, better prices, or more fundamental confirms. So here, when we're looking at Euro USD positioning, if we're not fully fading out this large bullish engulfing move and impulsive move and still holding above the 1.089s or breaking above here out of that short-term pullback formation, where even though Euro USD has had a bit of bearish plays over a few days, very small bearish candles, very large buyer liquidity grab wicks, not fully fading out the bullish impulsive move, we could easily still see, as stated there, Euro USD digging into these higher time frame prices, minimum, right? So that's why the short-term dollar bearish adaptation also lines up with Euro USD potentially still seeing some upside and retesting better sell zones on higher time frame positioning. That's why I still want to play the bullish positioning above 1.087, 1.09, 1.093. GBP USD is a similar idea. Yes, GU is very bearish on the higher time frame. Still has potential to drive into these lows once you have fundamental reasons for more dollar bulls. But we could easily still double top, triple top into this sell side liquidity zone before seeing the more higher time frame bearish positioning. For example, historically before bearish legs down, look at how many times you could retest into a liquidity zone before finally seeing the downside move. I still think we're going to get another retest into the 1.30s on GU specifically before seeing some more aggressive bearish moves, especially if dollar has reasons in the near term and the smaller time frame duration over the course of days, if not a couple of weeks, to still be bearish where it's individually dollar index is still retesting lower prices, like dollars coming down to 102s or 101s. GU could easily go back to 1.3 before looking for better sells, right? Now, GU's been a little bit choppier due to what's been going on at the Bank of England, but If we're still holding above this demand zone at the 265s and starting to break out of this bearish structure here, then I could still see us should be different color. I could still see us coming back to the same sell side liquidity zone we were targeting, even sweeping a little bit higher than this previous high here before seeing better sell positioning. I'm not fully confident in GU higher time frame bearish positioning with dollar correlation at the moment. So we're still going to be continuing the same trade ideas on GBP USD from the last market update, which is these intraday buy plays. UCAD. UCAD had a new intraday high printed, but with dollar starting to give back some gains, UCAD, now that a lot of this upside price action has been equally faded out here, a lot of this upside price action equally faded out. Very strong rejection from these previous higher time frame highs and breaking back below those highs. You can see when dollar short-term bearish, UCAD can have huge corrective waves the same time dollar short-term bearish, especially if oil starts to pick up some more strength, giving some support to the Canadian dollar. I'm not saying this is going to take place guaranteed, but UCAD could easily come back down to this same demand zone before we really think about better bullish positioning. These are huge corrective waves that take place from very key repetitive prices here. Hence, last week, we were adapting to these UCAD sells, 1.385s down to the prices we are now. I think we're still going to be extending that. This new daily and weekly candle also has a very minimal lower wick. Might just be pushing to the upside first, grab some more orders before flipping more bearish. On the intraday time frames, when looking at UCAD positioning, I'm still more generally bearish on the intraday time frames if we're holding below 1.38s, right? And we could easily be coming back down over the course of days to the same demand zone before thinking about better buys again, mirroring a lot of this upside movement, but to the downside now. So on UCAD, we're still going to be playing some of that short-term dollar weakness, bearish price action, potential of an aggressive pullback wave to retest lower demand zones, extending the trade ideas from the last market update webinar. I would still be looking for sells from 378, breaks below 37, USD CAD sells. US 30. Same trade ideas as last market update. I still see us clean this up a little bit now. I still see us retesting into the 40K prices before potentially seeing some short positioning. Shorts this week on US 30 would be if we get any more recessionary scare risks and higher than expected inflation data to push back some of the rate cut hopes and feed into a lot of the rate cut expectations being priced in. But I still see us retesting into there before better sell positioning into the 40K prices. Otherwise, continuation sells on US 30 are going to be below 39K and 38,500s. All right, everybody. So I've been yapping for a while now. It's quite a quite a long webinar, sorry, but we had a lot of topics to cover. We went through the weekly recap of key events from last week, some fundamental and technical refreshers, the schedule of events for this week, some breakdowns of price action, price anatomy, higher time frame to the intraday time frames, and translated that information to trade ideas. I want to thank you guys for your time in joining this meeting. I'm going to save and upload this right away to the main feed. And then I'll also be sending the rest of the weekly flow, like the economic calendar, weekend headlines, sentiment reading, and so forth. All right. But this is going to be saved and uploaded to Telegram first. So the order is going to be different than previous weekly flow weeks. Just because we're not using Vimeo at the moment due to this developer team fucking us. But we're just uploading the videos directly to Telegram, the weekly recaps, market updates, and New York session. We're getting rid of this marketing team and developer team, and we found someone else who made something that's even nicer and even better, working with something that Chris already had and she was working on because she's way better. So hopefully we can launch that this week, where you guys can get access to the Vimeo videos again and not even need Vimeo. You just sign into the Capital Hungry website now, not a Vimeo. But I'm gonna save and upload this, and I'll see everybody later. Tomorrow morning, we don't have much going on. I have an appointment at 11 a.m. But if I see some decent price movement, tomorrow morning's New York Zoom session will just start at a normal 8 a.m. And then obviously we'll have Zoom sessions Tuesday, Wednesday, Thursday, Friday for the key economic data reports, which should bring us some more volume and volatility. Still keep an eye out on headlines for any reactive events. I'm going to save and upload this, and then I'll see you guys later.